You're at a family dinner, and your uncle starts talking about the rental property he bought back in 2009. Best decision I ever made, he says. Real estate is the only way to build real wealth. Then your cousin jumps in. Nah, stocks are way easier. You don't have to deal with tenants or fix toilets at 2 a.m. And now you're sitting there with a fork in your hand, wondering who's actually right. Because both of them sound confident. Both of them have stories, but here's the problem. Nobody's actually comparing the numbers. They're just comparing vibes. So in this video, we're going to settle this properly. Stocks versus real estate. Which one actually builds wealth faster? Not which one sounds cooler at a dinner table. The real math. My name is Jack, and I spend way too much time thinking about how people should be building their wealth. If you've ever been stuck between just buy index funds and just buy a rental property, make sure to hit subscribe, because this is exactly the kind of confusion we're going to clear up. Let's start with a truth most people skip over. Stocks and real estate aren't really competing for the same job. They're two different tools that happen to get compared constantly. So let's break each one down properly, starting with stocks. When you buy stock, you're buying a tiny slice of ownership in a real company. Historically, the S&P 500 has returned around 10% annually on average over the long term, before inflation. That includes brutal years and incredible years averaged together over decades. The biggest advantage of stocks is liquidity. You can buy $50 worth on a Tuesday and sell it on a Wednesday if you need to. No paperwork, no inspections, no waiting months to close a deal. Now let's look at real estate. Real estate works differently because of one massive factor: leverage. With a typical mortgage, you might put down 20% and the bank covers the rest. So if you buy a $300,000 property with $60,000 down and that property appreciates just 5% in a year, you didn't make 5%. You made 5% on the entire $300,000, which is $15,000. That's roughly 25% return on your actual cash. That's the part people get excited about. Leverage can massively amplify your gains, but here's what most people don't realize. Leverage cuts both ways. If that same property drops 5% in value, you're still on the hook for the full mortgage. Your losses get amplified too. And unlike a stock, you can't sell half a bathroom to cover a bad month. So now we have two very different machines. Stocks. Liquid, historically strong average returns, easy to start small. Real estate leveraged can generate rental income, but slow to buy, slow to sell, and expensive to maintain. Here's where people usually go wrong with this comparison. They ask, which one has better returns? But that's the wrong question. The smarter question is, which one fits how much cash, time, and risk tolerance I actually have right now? Because the math only works if you can actually execute the strategy. Let's talk numbers for a second. Imagine two people both starting with $20,000. Person A puts it into an S&P 500 index fund, historically averaging 10% a year after 20 years with no additional contributions. That $20,000 grows to roughly $134,000. Person B uses that same $20,000 as a down payment on a $100,000 rental property. If that property appreciates at a more modest 4% annually, which is closer to long-term national averages, after 20 years it's worth around $219,000. Minus the original loan, that's meaningfully more equity than person A ended up with from the stock-only approach. Sounds like real estate wins, right? Not so fast, because that comparison ignores something huge. Real estate has ongoing costs. Property taxes, insurance, maintenance, vacancies, and the mortgage interest itself. Depending on the property, those costs can quietly eat 20 to 40% of any rental income, sometimes more in the early years. Meanwhile, person A's index fund just sits there. No tenants, no leaking roofs, No 2 a.m. phone calls. This is where it gets really interesting. The real advantage of real estate isn't just appreciation, it's that leverage plus rental income plus appreciation can stack on top of each other if you manage the property well. The real advantage of stocks is that they require almost zero active effort and almost no specialized skill to get the average market return. Now you might be thinking, okay, Jack, but landlords make way more money than index fund investors. Some do. But here's the part that gets left out of every dinner table debate. Real estate returns are wildly dependent on the specific property, the specific market, and the specific person managing it. A bad rental in a declining area can lose money for years. A boring index fund, by definition, can never go to zero because it's spread across hundreds of companies. Let me give you a quick analogy. Investing in stocks is like renting a fully furnished apartment. You move in, you don't have to fix anything, and life is simple. Real estate investing is like buying a house that needs constant upkeep. It can become more valuable over time, sometimes a lot more valuable, but only if you're willing to do the work or pay someone else to. So, which one actually builds wealth faster? Here's the honest answer most influencers won't give you. For someone with very little time, limited cash, and no interest in managing property, stocks build wealth faster in practice because the strategy is simple enough to actually stick with for decades. For someone with more capital, more time, and a willingness to deal with tenants, contractors, and local regulations, real estate can outperform stocks, mainly because of leverage doing the heavy lifting. But here's the trap almost nobody talks about. Most people don't fail at real estate or stocks because they pick the wrong one. They fail because they switch strategies constantly, chasing whichever one had a good headline that month. A buy and hold stock investor who panic sells during a downturn ends up with worse results than someone who just stayed boring and consistent. A landlord who over-leverages on 3 properties at once, expecting prices to keep climbing forever, can lose everything in a downturn. So instead of asking stocks or real estate, ask yourself 3 questions. First, how much capital do I actually have available right now? Second, how much time and energy am I realistically willing to commit? And third, how do I personally handle risk when things temporarily go down? If you have limited capital and limited time, start with stocks, specifically low-cost index funds, and let compounding do its job quietly in the background. If you eventually build up enough capital and you're genuinely willing to learn property management, real estate can become a powerful second pillar, not a replacement. Let's run one final comparison to make this concrete. Someone investing $500 a month into an index fund, averaging 8% annually, ends up with roughly $295,000 after 25 years. Someone saving that same $500 a month for 5 years to gather a down payment, then buying a modest rental property that appreciates 4% a year while covering its own expenses, could end up with comparable or even greater equity over that same 25-year window, but with significantly more effort, risk, and ongoing decision-making along the way. Neither path is wrong. They're just different machines requiring different inputs. And honestly, the wealthiest people I've researched for these videos rarely pick just one. They start simple with stocks, build a financial base, and only then expand into real estate once they have the capital and bandwidth to manage it properly. So here's the real takeaway. Stop asking which investment is better in the abstract. Start asking which one matches your actual life right now. Because the fastest way to build wealth isn't picking the best asset class. It's picking the one you'll actually stick with long enough for compounding to take over. If this video helped you think about this differently, hit subscribe. And I'm curious, would you rather own stock in 100 companies or one rental property you fully control? Let me know in the comments because that answer says more about your wealth building strategy than any return percentage ever could.